Andrew will see you now.
So you want to learn about bonds today? Great, well I am happy to tell you about it because guess what? There's a new asset class in town. Bonds are one of the most common investments within the realm of fixed income investing. For the last 2 decades, bonds have been dubbed boring due to their very low rates of returns. The only investors that took any interest in bond investing were really pension funds and insurance companies. It seemed like everybody, maybe yourself included, just wanted to trade GameStop, Bitcoin, and NFTs. But that has all changed in 2022. See, today, fixed income investing, which includes preferred shares, bonds, term deposits, and GICs, they're finally a solid asset class to invest in again. The reason for this is the insane amounts of new money supply and bloated balance sheets by the world's largest central banks, which have resulted in a high inflationary environment that we haven't seen in 40 years. It's caused these bond rates to skyrocket. As an example, a 2-year Government of Canada bond yield has gone from a 0.5% return just a year ago to 4.3% this year. That's a 9-fold increase in less than 12 months. Now, why is this important? Higher yields in fixed income mean more options for investors. With the exception of the global financial crisis, this is the first time in more than 20 years that investors can make more on their bank bonds than they can on investing that same bank's common share dividend. As a quick tutorial, when a bond investor is investing, they are effectively lending their money to the government or company that issued that bond. And there's 4 things that are really important to consider when you're buying or investing in bonds. Number 1 is the price. At inception, bonds are always issued at a price of $100, also known as par value. This price will vary as it's trading through the market, but it will always mature at par value at $100. Second is the coupon. The coupon is the rate of interest that a bond is going to pay to an investor, and normally it's fixed, but it can sometimes be variable. So for example, if a bond is issued with a 5% coupon, that means it's going to pay $5 of interest on every $100 of that bond from now until maturity. Now, most coupon payments are made every 6 months, so that would mean in this case, an investor would receive $2.50 on their $100 investment twice per year. Next item is maturity. Unlike equities, bonds have a finite life. On the maturity date of a bond, investors are expected to receive their final coupon payment and 100% of their principal in full. This is what makes bond investing much more predictable. And finally, credit rating. One of the great features of bond investing is that most bonds have a credit rating attached to them. These credit ratings help investors know how much risk is associated with lending their money to this company or government. As an example, the province of British Columbia is the only province left in Canada which has a AAA credit rating. Let's take all this theory that I've taught you about and translate it into a tangible investment idea. In this example, we're going to use the Royal Bank of Canada. Today, an investor can buy shares of Royal Bank and earn 4.1% on their common share dividend. By comparison, you can get 4.75% on a 5-year GIC and 5.5% on a 5-year bond. So with way less risk than owning the common shares, an investor can finally lock in an over 25% guaranteed return with one of Canada's major banks over a 5-year period. I hope you've enjoyed our conversation and learned a lot about bonds.